Throughout human history, every major financial superpower has believed its wealth, currency dominance, and global hegemony were permanent. In the 1600s, the Dutch guilder was the uncontested reserve currency of the global economy, anchored by the world's premier financial hub in Amsterdam. By the 1800s, the Dutch Empire gave way to the British Empire, which weaponized the Industrial Revolution and established the British pound as the world's standard asset. And following the Bretton Woods Agreement in 1944, the United States dollar assumed the throne as the undisputed global monetary anchor. However, legendary hedge fund founder Ray Dalio spent half a century studying the rise and fall of every major empire over the last 500 years to answer one critical question: why do the world's most prosperous nations eventually go broke? In his landmark book, Principles for Dealing with the Changing World Order, Dalio identifies a recurring archetype, a mathematical arc that he terms the Big Debt Cycle. This cycle averages roughly 250 years, moving predictably through three distinct phases: the early rise of productivity, the peak of debt, fueled consumption, and the eventual late-stage devaluation of paper currency. Today, as U.S. federal debt reaches historic levels relative to gross domestic product, net interest costs on sovereign debt exceed primary discretionary budgets, and international central banks alter their treasury reserve holdings, modern investors face an unfamiliar macro environment. Welcome back to Earnings Per Page, where we save you hundreds of hours of dense reading by distilling the world's best business and finance literature into actionable masterclasses. Today, we unpack Ray Dalio's empirical framework, analyze where the U.S. economy sits within the big debt cycle, and explore the precise asset allocation principles required to protect your purchasing power in the years ahead. To understand why empires fall financially, Dalio emphasizes that we must look beyond quarter-to-quarter stock fluctuations and study the structural life cycle of money itself. The big cycle begins in phase 1, typically following a major war or financial restructuring, when a country establishes a clear rule of law, high fiscal discipline, low debt, and a strong education system. During this phase, people work hard, save real money, and build foundational infrastructure, leading to rapid productivity growth and expanding international trade share. As the nation grows wealthier, its currency becomes universally accepted, eventually earning the status of global reserve currency. Reserve currency status allows the nation to borrow at significantly lower borrowing costs than the rest of the world, because foreign central banks and global investors actively seek to store their wealth in that nation's sovereign bonds. However, that exact strength sets the stage for phase 2, the overextension trap. Once a country holds the world's reserve currency, it realizes it can print paper money or issue debt to buy real goods and services from other nations. Over time, citizens consume more than they produce, living standards become subsidized by foreign leverage, and financial engineering begins to replace real industrial innovation. Debt growth systematically outpaces income growth because borrowing money feels easy and asset prices artificially surge, creating a false illusion of perpetual prosperity. Dalio warns that this middle phase creates massive internal wealth gaps and political polarization. As asset owners grow vastly richer while wage earners struggle under lifestyle inflation and rising living expenses. Eventually, the economy enters phase 3, the late-stage debt crisis. In this phase, total debt service obligations grow so large that taxes alone cannot fund government operations alongside debt interest. When central banks attempt to raise interest rates to suppress price inflation, sovereign debt servicing costs explode upward. Conversely, if central banks cut rates to reduce interest burdens, investors dump cash and low-yielding bonds in search of hard assets. The central bank is backed into a mathematical corner. It must choose between letting interest rates spike, which risks credit defaults and asset contraction, or printing money to buy its own debt, which devalues the purchasing power of the fiat currency. According to Dalio's historical data set, every major empire in history ultimately chooses money printing over outright sovereign default. Applying Dalio's historical lens to the contemporary U.S. economy reveals striking structural alignment with Phase 3 mechanics. According to official Congressional Budget Office data, U.S. gross federal debt has surpassed 100% of annual GDP, approaching debt-to-income ratios not seen since the immediate aftermath of World War II. However, unlike the post-1945 era, when wartime production converted into rapid civilian industrial expansion. Today's debt accumulation is driven by mandatory entitlement growth, persistent structural deficits, and skyrocketing net interest outlays. Net interest payments on federal debt now consume a significant portion of annual federal tax revenues, competing directly with spending on infrastructure, research, and national defense. This financial bottleneck is known in institutional macroeconomics as the fiscal dominance or interest trap. When federal debt expands past critical thresholds, standard monetary policy mechanisms lose their intended effect. When the Federal Reserve holds interest rates higher to tame price inflation, it simultaneously forces the Treasury Department to issue new debt at higher yields. That dynamic expands the annual deficit even faster, injecting hundreds of billions of net interest dollars directly back into the financial system. This creates a self-reinforcing liquidity loop. Higher rates produce larger government interest payouts, which expand fiscal deficits, which then require increased bond issuance. Simultaneously, the demand side of the Treasury equation is undergoing a subtle structural shift. For decades, foreign central banks, sovereign wealth funds, and institutional managers were non-negotiable buyers of U.S. Treasury debt. However, following global supply chain reorderings, shifting trade alliances, and strategic reserve diversification, global central banks have steadily reduced their relative share of foreign exchange reserves held in unhedged fiat paper. Instead, institutional data shows sovereign monetary authorities accelerating physical gold purchases and regional bilateral settlement agreements. When foreign appetite for sovereign debt slows while domestic issuance rises, domestic commercial banks and private capital must absorb the supply. If private capital demands higher term premiums to hold long-term debt, mortgage rates, corporate borrowing costs, and consumer credit yields remain structurally elevated. In Principles for Dealing with the Changing World Order, Dalio explains that economic cycles do not operate in a vacuum. They are driven by three interconnected forces that reinforce each other during transition periods. The first force is the long-term money and credit cycle, which governs how credit is created, expanded, and eventually devalued through monetary easing. When paper money decouples from physical collateral like gold or silver, central banks gain unlimited capacity to expand money supply during crisis. While this prevents immediate economic liquidity freezes, it slowly undermines confidence in paper currency over long multi-decade horizons. The second force is the internal conflict cycle, driven by widening wealth, opportunity, and values gaps. When the financial system rewards debt-asset inflation, those who own real estate, equities, and private businesses enjoy rapid wealth compounding. Meanwhile, those who rely exclusively on fixed labor wages see their real purchasing power eroded by rising housing costs, healthcare bills, and food inflation. Dalio's research shows that when wealth inequality reaches extreme historic highs, political systems gravitate toward populism, tax policy volatility, and increased social spending, which further widens government budget deficits and accelerates debt issuance. The third force is the external geopolitical conflict cycle, where a rising challenger state competes with an established incumbent superpower in economic output, technology, supply chain control, and military presence. As emerging economies scale their industrial base and technological infrastructure, global trade becomes multi-polar rather than single currency dependent, when internal political friction, escalating debt obligations, and external geopolitical competition peak simultaneously. The international monetary framework inevitably adapts. Investors who fail to recognize these overlapping cycles often make the fatal mistake of assuming the market rules of the previous 30 years will automatically function the exact same way over the next 10. How does an investor preserve wealth during the late stages of a big debt cycle? Dalio offers specific, data-backed principles for navigating structural currency devaluations and high fiscal volatility. First and foremost, Dalio emphasizes that cash is a trash asset over long horizons. While holding cash feels safe because its nominal face value does not fluctuate day to day, holding paper currency during a debt monetization cycle guarantees a steady loss of real purchasing power against tangible goods, real estate, and essential commodities. When central banks must choose between economic depression and currency devaluation, history shows they will always devalue the currency. Second, Dalio advocates for radical asset class and geographic diversification, a strategy he calls the all-weather engine. In a late-stage debt regime, traditional 60-40 portfolios, which rely heavily on nominal government bonds to hedge stock market drops, can experience systemic drag if inflation stays sticky and bond yields rise alongside stock volatility. To protect capital, portfolios require meaningful allocations to inflation-hedged assets, including productive real assets, high-margin cash-flowing equities, physical gold, scarce commodities, and short-duration short-term debt instruments that reprice quickly alongside inflation. Third, Dalio highlights the concept of productivity over leverage. Companies and individuals who rely heavily on cheap debt to engineer returns become highly vulnerable when interest rates stay structurally high or volatile. Conversely, businesses with low debt burdens, pricing power, and high technological productivity can pass cost increases directly to consumers, maintaining strong operating margins regardless of the macroeconomic backdrop. Building true financial immunity requires prioritizing real income, generating capability and balance sheet strength over speculative short-term leverage. Understanding Ray Dalio's The Changing World Order is not about predicting a doom and gloom economic collapse. It is about recognizing where we sit within historical money cycles so you can make rational, emotion-free financial decisions. To summarize Dalio's masterwork into 3 core rules for your personal wealth strategy, recognize the debt cycle. Sovereign governments cannot forever spend significantly more than they earn without devaluing paper currency. Base your long-term wealth plan on real inflation-adjusted purchasing power, not nominal account balances. Diversify beyond nominal bonds and cash. Avoid over-concentrating your liquid net worth in fixed paper debt or long-term low-yield paper instruments that get eroded by money supply growth. Hold tangible, productive, scarce assets that retain intrinsic utility. Prioritize balance sheet integrity. Whether managing personal finances or evaluating stock investments, emphasize low debt leverage, positive net cash flow, and strong productivity. Survival and outperformance during economic shifts belong to those who maintain a strong margin of safety. Thank you for watching Earnings Per Page, where we save you hours of complex reading so you can keep the insights that actually move the needle on your money. Make sure to hit the subscribe button for your weekly 15-minute macro and finance masterclasses and leave your thoughts in the comments below. How are you adjusting your asset allocation to navigate rising sovereign debt and inflation? Keep earning your dividends, one page at a time.